Morning, everyone. Barry Knapp, Ironsides Macroeconomics. It's Monday morning, October 13th, Columbus Day. Bond markets are closed, equity markets are open, so we're releasing this podcast and video on Columbus Day, even though the bond markets are closed. Our note this week was titled, "Nothing is Resolved or Fully Priced." And this is a reference to our call that we would have a 10 to 12% correction, and the idea that neither the fundamental catalysts for our correction have not resolved themselves, nor has it been discounted into the markets fully, either by looking at the absolute price decline, the duration of the correction, or the way vol markets have reacted to this, which is really how we gauge sentiment and investor positioning. So there's 4 sections in the note this week. The first one is an update on our correction forecast. The second one is it's not what they pay, it's what they pay, it's not what they say. And this is there's a broad section on the pricing of options and derivative markets and how to think about that, and a little bit of a how-to that we won't get into too much on this podcast and video, but is out there for our full paid subscribers. The third section was an earnings preview, with earnings season beginning this week, and then a review of the non-farm payroll report and what it means for policy in the markets. So first on nothing is resolved, there were several catalysts to our call for a correction. We focused heavily on monetary policy, but that was only part of the story. It was also tighter fiscal policy, tighter liquidity, and economic and earnings momentum that was had peaked and was turning a bit south. This is a rate of change argument again. Growth is slowing, but we don't think it will be slow necessarily. So on the monetary policy part of this story, the catalyst for this, the Fed essentially announced that they're going to begin tapering. Nothing that we saw last week, including the payroll report, we think will dissuade them from that. And you've gotten some repricing of expectations around when rate liftoff will come. What that is, when will the Fed first raise rates? And that has moved in significantly. Still, we don't think that that's fully discounted into the markets, and that you might still see the front end move higher as we get closer and closer to the taper process, and then inflation continues to surge the way it has done. Real rates have moved significantly higher as well. That's partially reflecting the fact that the Fed is unlikely to continue buying 100% of the supply of Treasury inflation protected securities, but real rates are still at exceptionally low levels, and we think they could move further. So we would categorize 2 of the 3 main channels that large-scale asset purchases affect the equity market through as having partially adjusted, but not fully adjusted. The final channel, the one that we focus on very heavily, but most strategists, economists, and market participants seem to either dismiss or don't understand, is the volatility channel. And in that case, we haven't seen it priced. The Treasury move index is still a full standard deviation below its long-term mean. It's moved up, but surely is not pricing in an end to mortgage-backed securities purchases, which will move fixed income volatility significantly higher. On the fiscal policy front, the continuing resolution and debt ceiling deal now push this process out to the beginning of December. Given that the Democrats are still haggling over the size and the composition of the budget, spending, and the tax hikes, the markets can't possibly be pricing this. There was news about a global minimum tax hike on Monday. The markets have not reacted to that either, although we still think that's unlikely to ever really be ratified by the vast majority of countries. Nevertheless, the markets, the broader point on fiscal policy is the markets are unlikely to really start to discount that tighter fiscal policy until we get much more clarity on what it's actually going to look like. We don't have that right now. On the liquidity front, keep in mind that the debt ceiling deal means that the Treasury can start issuing securities again. That's going to drain liquidity out of the system, not add more liquidity to the system. So that's not priced in the market either. And then on the growth earnings momentum front, earnings revisions are still falling. So even though it looks like we'll have a good quarter on an absolute basis, those revisions are still falling and have not bottomed out at all. So final point about all this, for those looking at the video or full subscribers, you can see our Fed's correction table. We're about halfway through in terms of price. And typically these corrections, or the average for these corrections in the 2010s, the 8 of them that we had in response to the Fed trying to normalize policy, the average duration was 60 days. We're 30 days in. So we're only about halfway there in terms of time and price. Okay, moving on to the volatility markets, and it's what they pay, it's not what they say. We've always preferred looking at index option markets and volatility markets to really gauge what investor positioning is like. So on the fixed income side, it's very clear that the Fed has suppressed interest rate volatility. The street is not long volatility. When they become long volatility, that volatility is going to move up, and that's going to permeate out across asset classes. From an equity perspective, for us to think that this market was cleaner in its positioning, that investors had become somewhat net short, we'd like to see the VIX above 30. We'd like to see the term structure, that's the VIX curve, invert, meaning the 1 month future be higher than the 6 month future. We'd like to see implied correlation above 60. We'd like to see wider credit spreads. All these things are moving up somewhat, but still not to the level that would indicate that the market is really cut risk significantly. So when you look at all these indicators, the VIX is the most widely watched, which doesn't mean it's lost all of its efficacy as an indicator, but it is the most widely watched. The term structure is not as widely watched. We've been describing that since the global financial crisis as the new skew, meaning it used to be that you'd see a bid to out of the money options when investors got nervous. Now, instead, what you typically see is them raise cash and then skew gets cheaper, which is somewhat what's happening now, though we haven't gone all the way there. And skew has gotten elevated in points when investors are really long. So skew's efficacy as a contraindicator is not what it once was. It's gotten a little more complex. For example, during the meme stock frenzy, if you will, skew got bid, but that was because upside calls got bid, not because downside puts got bid. Typically, that's the way we thought about skew, was people buying portfolio insurance. So, and then correlation can be thought of as when correlation is high, macro risks are driving share prices. When correlation is low, it's more about alpha and individual stock stories. That's way oversimplified, but you can read our note for a little bit more amplification on that. Moving on to the earnings outlook. Revisions, as I said, are still falling. So I would have to think at this point that the reaction to earnings season is going to be skewed somewhat negatively. Expectations are for 30% earnings growth on 14% revenue growth. Those are obviously very big numbers again, but about a third of what they were, at least on the earnings side, last quarter. The strongest gains in earnings are going to come from the energy sector, material sector, and industrial sector. The largest contributions to growth are going to come from energy, tech, and industrials. The largest absolute contribution to earnings come from tech, financials, and healthcare. But you can see that it's those reflationary sectors that are providing all the upside this quarter. When we look through all that, we think that one spot to keep your eye on is industrial sector margins. Investors have become very concerned about some of the pre-announcements and this idea that marginal costs are rising far faster than marginal revenues. When you look at regional Fed manufacturing surveys, you actually see that started to correct itself several months ago. So it may not be as bad as investors think. And when you look at industrial sector margins relative to peak, even though the S&P is above peak, industrials have quite a bit to go. So we still think the risk reward is skewed favorably for that sector. They reacted favorably to second quarter earnings. We think they will again to third quarter earnings. Financials kick it all off. Financial earnings will likely be somewhat disappointing. Investors have bid up the stocks because the yield curve is steepened, it doesn't translate to net interest margins nearly as quickly as investors believe. That could create some room for disappointment. Loan growth is improving on the consumer side, so that's a little bit better than it's been the last few quarters. But the upside to earnings is mainly going to be about credit growth. We would expect earnings as stocks to react somewhat negatively to earnings, but remember, they're returning capital to shareholders. So if you sell the stocks, you might be selling it into a company bid. So we're not worried about financials. We just don't think it'll provide a big upside catalyst. A couple of final thoughts on earnings season. One is, while we think there could be room for disappointment in this quarter and perhaps even next, 2022 earnings expectations are for only 9.1% on 6.5% revenue growth. That's a level that we think will create operating leverage. Stronger nominal growth, stronger revenue growth probably means positive operating leverage. Investors are concerned again about this marginal cost versus marginal revenue argument. We think that there's a lot of upside to next year's earnings, although obviously if you raise corporate taxes significantly, that could be something of an offset. The final point would be we would expect an asymmetric response to earnings beats and misses. Beats will probably get a fairly muted positive reaction. Misses will probably be, especially when they're, well, misses by definition are unexpected. So we think those will probably be hit pretty hard. Okay, final section of the note this week was about the labor market, and we titled it "Take This Job and Shove It." This is a characterization or a reference to all the 5 million people that have essentially left the workforce, and at this point not showing a lot of interest in coming back. There's been some 2.5 million retirements. The labor market is tight. We've been writing about that, talking about that for months. It's unequivocally tight. Now, a couple of caveats. This was similar to a number of employment reports we got this year, particularly in the spring, where you had a misleading headline, but the underlying tone of the market was, or the report was actually quite strong. The bond market was obviously not fooled by it. We had bear steepening as a consequence on the back of the report. Unseasonally adjusted, there was actually 1 million jobs created. We think the government is still struggling mightily with seasonal adjustment factors. The same thing happened after the global financial crisis. This is even worse as it pertains to teachers. But then measures of labor market slack improved, or showed far less slack. The U3 unemployment rate dropped from 5.2 to 4.8. The U5 underemployment rate dropped from 8.8 to 8.5. The percentage of short-term unemployed moved up from 24.5% of the total to 28.7% of the total, but the percentage of long-term unemployed moved sharply down from 37.4% of total unemployed down only 34.5%. So it's a lot more dynamic than it would look. The work week moved up a bit. Median duration of unemployment, number of weeks it takes to find a job, that moved down sharply. And obviously wages are moving up pretty sharply as well. We like to look at the non-supervisory series. That's been around much longer. That moved up from 4.8% to 5.5% on an annualized basis. There's a chart we showed in our note, and it'll be on the video, that shows small business wage pressures. They've never been stronger than this. This is a big issue for the Fed. And on a side note, there was a University of Chicago study that came out last week. The link is in our note, that showed that the child care credit, if it gets extended, could cause an additional 1.5 million workers to leave the workforce. That's all we need at this point, right? Is to create an even tighter labor market. So there's no way, if the Fed looks at this honestly, and they were already focused more on supply than demand, they could say this is a reason not to taper. It's a reason to taper even more quickly, because the labor market is hot, and it really does risk getting inflation expectations up above what Jeremy Rudd, the Fed economist who wrote the report about expectations, where he said it may be that there's a threshold level where it really starts to matter at, say, 4%. And we're well on our way to the public beginning to expect inflation to be running better than 4%. and that having meaning that inflation expectations get embedded and then it becomes something of a self-fulfilling prophecy. So that's it for me this week. Bottom line here is none of these issues that led us to look for this correction have been resolved. The markets aren't pricing it. The vol markets in particular are not pricing it. We do need the market to go probably down to around 4,100 or so in the S&P and to see the VIX above 30, the term structure invert, higher correlation, and fixed income vol to move up in order to really believe that a bottom is in. So that's it for me this week. Everyone have a nice week. Barry Knapp, Ironsides Macro. Thank you.